Hi, I'm Melanie Carter.
And I'm Dominique Bergevin. Welcome to Trade Talk. Today we're talking about how companies can get more money from their bank to grow their international sales.
Access to financing is one of the biggest challenges for small to medium-sized businesses, and especially when you're trying to go abroad. International trade is riskier than domestic trade, and some banks may be reluctant to extend credit.
In a few minutes, we're talking with Greg Matthews from RBC Royal Bank and Sophie Dumoulin from Export Development Canada. But first, here are a few fast facts on the challenges facing Canadian companies when expanding operations overseas. International payment terms tend to be longer than those extended domestically, with 180 days being typical. Not getting paid is a common risk for Canadian businesses working abroad. Overseas customers may require the issuance of a performance guarantee to protect themselves against the risk that the work is not completed, which can be a strain on the exporter's working capital. And, as the current environment reminds us, selling abroad exposes Canadian exporters to the risk of unfavorable foreign exchange fluctuations.
Banks weigh in on these risks when considering financing options for exporters. So it can be challenging for Canadian exporters to access the cash they need to cover their expenses and expand their business. Recently, I had a chance to sit down with Greg Matthews, a commercial account manager at RBC Royal Bank. I asked him about how companies can pitch themselves to their bank.
Number one is tell us what you need the money for. So give us a tale, give us a story about the money itself. What are we using the money for? How can we help? The second would be show us, don't tell us when it comes to the financial side of your business. So explain to us where you've been, where you are to date, and where you're going with forecasts. And then the third piece is how are you working with existing partners, such as Export Development Canada and the Business Development Bank, your Crown Corporation partner. So tell us those three things. It's a great start to the conversation.
So talking about risks, right? That's what you assess as a bank. Tell me how EDC mitigate those risks for both the client and the bank.
Absolutely. So EDC, as a partner of the Royal Bank, works with exporters, companies in Canada who maybe have a good news, bad news story. So the good news is I've landed this amazing contract. The bad news is I don't necessarily have the working capital in my existing operations to execute. So with Export Development Canada and EDC, we're able to work with the different solutions that you have in order to help clients execute abroad. EDC doesn't just bring the financial products and services to it either. You also bring a large level of advice, a large level of understanding of the countries that these companies want to go to, because you often have people on the ground. So there's a whole other level of comfort that comes from working with Export Development Canada. So
how do we help your customers further in accessing financing?
Sure. So there's a few different ways. One that we've discussed previously and we've worked together on is the everyday working capital. So most companies will come to us and say, again, I have an opportunity. I don't necessarily have access to the money within the everyday operations. How can you help bank? How can you help RBC Royal Bank? So we will work with Export Development Canada and help understand, is it a good news, bad news purchase order where yes, I have, this contract in hand, I have a purchase order, but I don't have the working capital to execute. Well, EDC's has solutions that we're able to leverage with clients in partnership and be able to help them get to where they want to be, bring the business from where they are now to where they want to be in the future.
Thank you so much for your thoughts, Greg. Much appreciated.
Cheers.
It's important for businesses looking for financing to have a story to tell their bank. Banks need to know where your company has been, where it's going, and why the money is needed.
Even with a clear vision, banks will require collateral when taking on certain risks, causing a strain on working capital.
Sophie Dumoulin, an expert in contract insurance and bonding at Export Development Canada, shared stories with me about how EDC can help businesses free up that collateral that is otherwise held up by their bank.
The experience we see can vary quite a bit from a company to the other. Factors that will influence that will be, for example, the type of market they're trying to grow into, the structure of their company, access to financing, working capital, the experience of the management into those types of markets. So we tend to see quite a range of experiences.
So if we look at the two different ends of the range, where would a bank feel comfortable offering finance, and where would that comfort start to wane, and where they really don't feel comfortable? Can you maybe share with us those two extremes?
For sure. So a short-term contract close to home, so for example, United States, a 3-4 month contract for something that they've done many times before domestically. This is something usually that is much more accessible for the banks to finance or provide support because it's known and it's palatable. Mm-hmm. The further we go into the world, into different markets, maybe some are more unstable than others, that's where it becomes a bit more difficult. Same with duration. A 5-year contract in a market that may experience different challenges, then it can be much more difficult for the company to get support.
So in that shorter term, in lower risk market, you'd be getting a line of credit from your bank that would finance your ability to service your contracts, whereas in the higher risk markets in the longer terms, that financing may be less available. Can you maybe give me an example of what a company would do when they are faced with opportunities that are in the longer term or in higher risk markets?
The foreign buyer may say, well, we don't know you, we've never dealt with you before, so we're asking for a performance bond to be posted. The bank will be able to issue that for the company, but they will freeze the same amount on the operating line.
So taking away some of their financing, basically, or access to financing.
Exactly. So it reduces the availability on their line, and they may have needed that amount to perform under the contract. So that's one risk that the company may be facing, and a demand where we actually can provide a solution. So our solution in this case is we guarantee to the bank the instrument, so they don't need to take collateral from the Canadian company. So with our guarantee, the operating line doesn't get frozen, and they have access to their full line of credit. And if there is a call on that guarantee, there's a problem under the contract, then we pay the bank, and then we have recourse to the Canadian company to get reimbursed in turn.
So the bank is de facto offering that line of credit without any restriction on it because of the EDC guarantee.
That's exactly it. In addition, though, you may say, well, what if the foreign buyer calls on that guarantee, but it wasn't justified? We don't know them either. So what if it's an unconditional instrument? So what if they call, but the Canadian company had performed under their contract?
Okay.
So for this type of risk, we have a wrongful call insurance.
Okay.
So this is truly an insurance product where if the company chooses to pay the premium for that insurance and there is a call, they can submit a claim to EDC and we'll look into the facts of the contract to determine if it was a wrongful call or rightful call. But if it was a wrongful call, the company is protected, and then we won't have asked them to reimburse us for the amount. So
there's two different products or solutions that are available to customers. One is first to free up that line of credit that would be otherwise tied in order to enable that performance bond. And the other one is if there's a wrongful call in that bond, and EDC would be there to protect in that case as well.
Exactly. And finally, the last risk that company may want to look into is the currency fluctuation. So
very timely right now.
Exactly.
So what are the solutions that EDC has to offer there?
So they can get a foreign exchange line with their bank, but the bank will also take collateral for a certain portion of that line just to cover themselves in case there are mark-to-market adjustments.
Again, tying up their financing.
Exactly. So similar as the first example, we can guarantee that amount of collateral for them as opposed to them asking the Canadian company to post it. So their operating line in that case also remains fully available.
Excellent. Thank you very much, Sophie. So as you can see, businesses need access to working capital in order to expand their business overseas.
Exactly. The working capital might be to finance marketing costs, or it could be to hire personnel to be able to fulfill a larger than usual contract, or it may be simply to give access to more cash flow to be able to finance the cost upfront of our larger than usual contract.
And while that working capital need is there, as we saw in our episode, banks tend to shy away from financing international growth.
Right, but there are ways for exporters to strengthen the relationship with their bank.
Like we saw the example of where a company needs to issue a performance guarantee and where partnering with EDC there can help unleash that collateral that would otherwise be required.
Before we sign off, don't forget that EDC offers a wealth of information about export financing. To get a copy of our guide to unleashing more financing from your bank, visit our website at edc.ca. Thanks for watching. I'm Melanie Carter.
And I'm Dominique Bergevin. Until next time, keep talking trade.